Paul, it appears to be that we are back where we started on Friday night. What is the takeaway, though, from the we're going to get 50% tariffs being imposed on Europe to we're going to push back to the original date? Is there any signal in this noise? Because basically, if I look at equity futures, we've completely round-tripped.
Yeah, good morning, Guy. I think, yeah, you're right. Probably three or so takeaways that you could extrapolate from that. However, you know, if you're in Asia and you went home on Friday after markets closed here, you know, you heard about the European news in the evening or maybe on Saturday morning, as you were saying. We went to bed on Sunday expecting a volatile market open. Got kind of the opposite when we came in because already Trump had revoked those tariffs again. So more of a flip-flop. But on the other hand, something that achieved something because he seems to have managed to get Ursula von der Leyen on the line, made some progress potentially in terms of what he wants to achieve with Europe and being able to push back those tariffs. I think the market is reading it in a number of ways. One, a little bit of relief again. So funnily enough, even Asian stocks managed to rally, even though they had no sort of downside on Friday from this. We've got futures higher for US and European markets today too. Second, though, it's that unreliability factor coming back into the market equation again. People thought, oh, perhaps we're out of the woods here on the tariffs. We don't need to worry about it so much. No, back they come again. And you see that mostly in that pressure on the US dollar. Right across the board, wherever it is, the dollar is weakening again. Emerging market currencies stronger, developed market currencies stronger. You know, the euro, the pound, everything having a good day, partly because of the relief on the tariffs, but partly because people are just concerned about, you know, putting their money in the US and it being that safe store of value that it's always been hitherto. And so that's probably what the market will take away more than anything else from another very floppy move from the US president.
Well, Paul, how does that move from the U.S. president ripple effect into the bond market? Because I'm looking at a bond market that's largely been range-bound for quite some time. Why is there not more of a reaction function in that part of the market?
Yeah, well, I mean, you are seeing that continual rise in long-end yields at the moment, and that's the predominant theme overriding everything else in the bonds market. The Fed is on hold. It's not gonna be cutting, but it's not going to be raising interest rates, and people are worried about that inflationary impact, but they're more worried about the supply impacts with the big tax bill going through Congress and the House and the Senate at the moment, taking some more time there. People are worried that spending is getting out of control, that there isn't that appetite for long-end bonds at the moment, and we're seeing those continually rising yields as a result of it, kind of regardless of the trade policy, but also, once again, that kind of same factor playing into it, that the rest of the world is a little bit less keen on US assets overall, particularly if the dollar is weakening, but also as a store of value and a haven kind of a trade. And so that's why you're seeing that shift out of US Treasuries. At the same time, by the way, while yields are rising everywhere else in the world, people all piling into the short end of bond markets all around the world at the moment, but showing their disdain almost for the US policies by coming out of the Treasuries market.